Like I told you before the break, when you pack into a crowded trade, you're playing with fire. If everybody's on the same page about a stock or even a whole sector, that means the easy money has already been made, people. Doesn't mean you can't profit from something obvious. That does happen. But when you're late to the party, you're going to have lower returns and higher risk. That is the nature of the beast. Fortunately, nobody's putting a gun to your head. That would be terrible, right? And forcing you to follow the hedge fund herd. In fact, you don't even have to think about spotting tops and bottoms by gauging sentiment if you don't want to. There are a lot of different ways to invest. Some of them take less work than others. For example, there's timing. Now, you could try to call every gyration in every average, okay? Buying stocks when they look poised for a near-term bottom and then selling them when they look toppy. You can trade around the core position. You can take a large holding, and then you can lighten up on part of it when it gets overextended and buy it back when the stock sells off. You can keep your bat on your shoulder, waiting for the perfect moment, where the whole market sells off dramatically, giving you a chance to buy your favorite stocks for much less than they're worth. Now, back in my old hedge fund, I love doing this stuff. If you got the time, the inclination, the right resources, it's a terrific way to try to make money. But if you've got a full-time job, this whole approach is lunacy. And I say that as someone who knows a lot about crazy. Regular people who work for a living don't have time to stare at the tape all day. Even if you work the night shift, it's not a good use of your precious free time. More importantly, it's not worth the agitation. And that's why I come in here every night to do the show. I focus on the market like a hawk so that you can take a less intense approach to investing, one that lets you go to work and have a personal life. So how should you approach the market if you're not prepared to devote your entire waking life to watching stocks? What's the safest way to handle individual stocks part-time? For starters, let me just say again that index funds are a wonderful thing. Won't it be great if anyone says, oh, Jim doesn't like index funds? I can point to this show and just say, did you listen to it? It's like 40,000 times. If at any point what I'm describing sounds too daunting or just too time-consuming, don't hesitate to say individual stocks are not for me. Throw your hands up and just put most of your mad money, the cash you invest with that's not part of your retirement portfolio, into a nice low-cost index fund or ETF that mirrors the S&P 500. I tell you this a lot because it's good advice. Being a savvy stock investor takes work. Being a savvy index fund investor, it is easy, or relatively so. Sure, if you manage your portfolio well, if you do the homework and stay disciplined, I think you can beat the S&P 500 with a diversified group of individual stocks. I've seen it happen hundreds of times. But not everybody has that kind of time. Not everybody has the temperament. Not everybody is comfortable taking on more risk to chase a higher return. And that's perfectly fine. You need to do what is right for you. So keep that index option in your back pocket. Assuming you really do want to try to profit from individual stocks, let's talk about how you can do that without the market taking control of your life and just constantly living in a ball of worry and confusion. First, from the get-go, you need to accept that the best is enemy of the good. There's no point in trying to buy or sell stocks at the perfect moment. Nobody's that talented. Even making the attempt will drive you nuts. You need to accept results that are good enough rather than trying to chase perfection. For example, if a stock you like gets hammered down, let's say from 60 to 50, and then you pull the trigger, but then it goes down another couple of points before it bottoms and rebounds to 60, don't kick yourself for making a mistake. You didn't screw up. You made a great pick. You could have made a couple extra points if your timing had been flawless, but a win is a win, people. Second, regular viewers know that I don't believe in buy and hold. Now, wait a second. Cramer's breaking the orthodoxy? No. I believe in buy and homework. Buy and hold, to me, is reckless. Buy and homework is prudent, meaning you need to keep researching your companies after you own a piece of them. And if something goes wrong, terribly wrong, you got to bail. I think it's a good idea to buy stocks slowly on the way down and sell them gradually on the way up. All of that requires a certain amount of active management, but don't feel compelled to be too active. The last thing you need is to be flitting in and out of stocks with every gyration in the broader market. I don't want that. You want to be an investor, not a trader. You think you can time things perfectly and flit in and out, but most gains occur in concentrated bursts, and you're liable to miss them if you're on the sidelines. Again, if you've got the time and the inclination to trade, that's great. However, most people don't. When you've got a full-time job and you're trying to manage your own portfolio, you have to be willing to sit tight. There will be sell-offs. There will be rotations out of one group and into another. There will be crazy action on a week-to-week and even day-to-day basis. You don't have to constantly adjust your holdings based on those moves. That would be wrong. If you believe in the stocks you own, and you shouldn't own anything you don't believe in, just sell them, then you should be willing to stick with them when the backdrop gets tough. You can't just bail. Ideally, you would be able to trade in and out. But like I told you, the best is the enemy of the good. Don't chase perfection. In practice, when everybody's panicking over the latest crisis, you're going to be tempted to just sell everything. And you might even avoid a substantial decline by bailing on the stock market. But sooner or later, you have to get back in. The whole point of sidestepping the decline is how to sell high and buy low. Unfortunately, it's really hard to nail the timing here. If you dump everything, there's no guarantee you'll be able to buy your stocks back before something changes and the market comes roaring back, something we saw, by the way, in the spring of 2019. After Fed Chief Jay Powell told us some rate cuts might be on the horizon. Wow, okay? That would breathe new life into the economy. So what's the solution? If you don't want to give yourself a panic attack every day, keep doing the homework so you know what you own. When your stocks surge higher, use that opportunity to ring the register on part of your position and raise some cash. After a 20% move or more, you need to take something off the table. That's my ironclad rule. A little something, okay? When your stocks get hit, put that cash to work, buying more shares at lower prices. But you don't have to nail every short-term top and bottom. That's too darn hard. Bottom line. To trade or not to trade, that is the question. If you're trying to be an investor who doesn't need to stare at the tape all day long, it's nobler in the mind to suffer the slings and arrows of outrageous fortune. You don't need to be perfect at managing your money. You just need to be good enough. And that means you shouldn't waste your time trying to anticipate every little gyration in the market. It's too darn difficult and will rarely prove to be worth it. Let's speak to Ryan in New Jersey. Ryan!
Hey, booyah, Jim. How you doing?
I am doing well, thank you. How about you?
I'm doing good. I'm looking to invest my first $20,000. I know that putting the first 10 into an S&P 500 base index fund is a smart move, but I'm wondering what to do with the other 10. I don't have time to do my homework. I'm wondering if it's a good move to go with index funds and ETFs for the other 10.
Yes, if you do not have time, you must. And I don't want those small sector ETFs. I prefer a total return fund that has all sorts of stocks or a fund that has a high growth. I don't want it sector by sector because those funds tend to not make people money because people buy them high and sell them low. Let's go to Riley in Georgia. Riley.
Yes, sir. Thank you for taking my call. You are the man.
Oh, thank you.
Yes, sir. I was just asking, what kind of percentage would you recommend of gold in your portfolio? Either physical gold or something.
I think 10% is fine. I know that it's been terrible, but, you just like insurance. You don't want insurance to pay off, do you? It's insurance and nothing else. All right, don't try to anticipate every gyration in the market. Just do the homework on what you own. There's much more mad money ahead. Nothing generates enthusiasm for the stock market like a newly minted company. But I'll tell you why you should proceed with caution the next time you see a company coming public. Plus, being at the right place at the right time is essential in investing. I'm showing you why. But first, shh. Hear that? It's the tape talking. I'll help you separate the signal from the noise. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.